Well, markets closing higher today. The big economic data point today, another hotter than expected inflation report, this time on the wholesale side. Producer prices rising more than estimated in April, comes ahead of tomorrow's CPI, consumer price print. For more on what that means for investors, let's bring in Bryant Van Cronkite, portfolio manager at Allspring. Thanks for being here, Bryant.
It's a pleasure. Thank you.
So this is not the relief that people were hoping for, perhaps, on the inflation front today. But I know that CPI is seen as more important in the eyes of the market. But how are you sort of weighing the PPI report?
Yeah, under the covers, the PPI report was more benign than maybe people feared on the surface. So I think it's a good sign for maybe people who are worried about inflation staying sticky. And the market, I think, moved higher in that today. But there's a lot of pressure on the CPI tomorrow. Right? I think the market clearly is hoping the Fed can jump through that ever-closing window with a prospective rate cut. But inflation has to cooperate. And every data point we have going forward is one more chance for that window to slam close on them. So tomorrow's the big day. The market could be volatile around it, and we'll see what it has in store for us.
And Brian, are you in the camp that confident that actually inflation, the trajectory of it, we do get back to Jay Powell's target and he is able to cut this year?
I'm actually concerned we're not going to get there at the pace the market thinks we're going to get there. I think inflation could stay sticky, largely because the problem here is the employment situation. Both the quality and the quantity of labor is not meeting the needs of the small businesses and large businesses and what they need to drive their businesses forward. And so unless we see that employment situation get fixed, I think inflation is going to stay a little bit sticky right now. The only thing that could maybe change that, in my mind, is the consumer weakening faster, putting pressure on GDP, putting pressure on the economy, but that's not a good situation. But that could be our reality.
Right. I mean, that's what we've always heard from people over and over again. If the Fed is cutting for quote unquote good reasons, right, then the market can still go up. If it's cutting for quote unquote bad reasons, there's too much slowing.
They'll be judged not by what they do, but in which context they do it.
Right.
And if we're seeing GDP dropping, unemployment rising, the market's not going to care that they've cut. They missed that prospective window. Now they're reacting, and that will not be a good thing for markets.
So on the consumer spending side, are you seeing concerning signs? It seems like we're hearing sort of anecdotally from companies that they're seeing a little bit of weakening.
The consumer's been remarkably resilient for much longer than I think most of us anticipated, certainly more than I anticipated. But our channel checks this week even show it slipping further and further up in the income cohorts. So it started out as maybe the lowest end consumer, starting to make tough choices, trading down to more value categories, moving into private label. We're now hearing just this week that a lot of our grocery channel checks, our restaurant channel checks, even the retail, that consumer is now the $100,000 household, which it's moving up now. And as it moves into the middle income, that's when things get a little bit more dicey for me. So I'm getting more and more concerned in the last week or two.
I'm interested, Brian, we've been talking a lot on the show today, Biden imposing these new tariffs. And obviously, a big part of that is it's just raw politics, right? You're trying to win votes in key swing states. It brings the election kind of back in focus. How much are your clients asking you about that right now, Brian?
Well, they recognize that elections bring volatility, but ultimately, a lot of what we're hearing today is more politics, less economics, right? The tariffs impact about 8% of the imports from China right now. That wasn't a huge news event. Clients are just worried about what's the plan going forward. Right, the regulatory backdrop for a lot of industries matters. And it seems like whenever someone else comes into the White House, we cancel everything we just did the last 4 years and start again. And that's frustrating for investors. It's frustrating for a lot of people in every line of work. And so what people want is stability. They're not going to get it right now. So we're just going to kind of trudge through. And the way to trudge through it is focusing on what a company can control. Our approach to investing is really understanding how a company's financial freedom, as measured by their balance sheet, allows them to kind of navigate any market environment. That's the key for investors right now, is focus on what you can control, use balance sheets to measure that, and then drive forward with your investments that way.
So who's doing the best job controlling right now? Or I guess I can ask that a couple of ways. What sectors are best poised to do that right now? And are there examples of companies that are doing a good job of that?
Well, staying with the consumer for a minute, I think consumer discretionary is a more dangerous place to be. So I would underweight discretionary right now and overweight consumer staples. Consumer staples have been left behind valuation-wise, I think for good reason. Because the consumer has been resilient, because the economy is stronger than what we expected, people were kind of ignoring the 3 to 4% top line growing staples groups and putting capital elsewhere. We're starting to see that reverse now. And what I'm seeing are names like Keurig Dr. Pepper or Church & Dwight doing a really good job investing through innovation to drive higher market share, drive and maintain higher pricing. That's going to show up as stable and growing free cash flow, even if we see the economy slow down. So I like consumer staples, and those two names in particular relative to consumer discretionary.
You also like the construction market, Brian, or at least names in that sector?
There's opportunity there for sure. the infrastructure bills got passed a few years ago now, and we've sort of forgot about them. But so much of that money is just now flowing into the economy. So a name like Vulcan Materials that provides the aggregates that go into roads and bridges and buildings, they're seeing a very strong demand pipeline right now and good pricing. Jacobs Engineering, another company that's benefiting from the CHIPS Act. They're doing a lot of the engineering and design work as companies move semi-manufacturing into the US. So there are pockets of opportunity in construction, in building that I think are still undervalued because they have long duration on the revenue streams.
Brian, actually, I have one last question for you because, we talk to New York City people a lot. You are based in Milwaukee, and I'm just curious, we talk a lot about the vibes, right? The consumer vibes. And I'm just curious if you see a difference in the Wisconsin vibes versus the East Coast or the sort of bigger media narrative.
I think that the way someone reacts to news is different based on where you live. I have the luxury and the pleasure of traveling the world, and some people in certain locations respond very quickly, and sentiment drives that. In other places, it seems to be a little slower, more relaxed pace. Out to the Midwest is known for a lot of things, and maybe on the investment side, maybe for that longer time horizon, right? We're not so worried about the sentiment, the short term. We're focused on the long term, and I think that's what differentiates maybe our Milwaukee presence versus some other coasts. But make no mistake, having the ability to work with people, my team is all over the country, having the ability to work with them and understand what you're talking about, because it's a better, more diverse view of the world and what people are thinking.
Makes sense. Brian, thanks so much.
It's a pleasure.
Appreciate it.